$5.9 trillion got wiped out in 30 minutes. Gold and silver just experienced one of the most violent crashes in modern history. And if you do not understand what happened, you are going to get destroyed by what comes next. January 29th, 2026. Gold crashed from near $5,600 to $5,100. Silver plummeted from $121 to $107. Over $3 trillion in gold value erased in one session. This was not normal market behavior. This was not retail panic selling. This was something else entirely. Here is what makes this critical. This is not financial advice, but the exact same pattern happened 1 month ago. December 29th, silver hit $84. By December 31st, down to $70. A brutal 16% crash in 2 days. Everyone called it the end. Then came January. Not weeks later, days later. Silver rocketed from $70 to $121 in less than a month. 65% gains. Gold surged 30%. The biggest monthly rally since 1979. So is this crash the end, or is history about to repeat itself? I am going to show you exactly what caused this crash, not surface-level explanations. The actual mechanical forces that move trillions in minutes. And I am giving you a specific prediction with a specific date, but you need to understand something first. What happened on January 29th was not really about gold and silver at all. Most people watching precious metals are staring at the wrong charts. They obsess over gold and silver tick by tick, and they completely miss what actually drives these markets. Let me show you something that will change how you see this forever. While everyone was watching metal prices, the real earthquake hit somewhere else. Microsoft earnings. The biggest software company on earth just revealed the AI gold rush is not paying off. Azure cloud growth slowed to 37%, down from $37 billion in capital expenditure in 1 quarter alone. Wall Street asked the critical question, where is the return? Microsoft crashed 12% in 1 day. $440 billion in market value gone, but it did not stop there. Oracle down 5%, Nvidia down 3%. The entire AI sector is bleeding. And when the AI bubble shows cracks, it does not just hurt tech stocks, it crashes confidence in the entire growth story, including gold and silver. But here is where it gets interesting. This was not just about sentiment. This was about mechanics. The machinery under the surface that most people never see. And understanding this machinery is the difference between getting destroyed and seeing what comes next. Let me explain something critical. When massive rallies happen, exchanges protect themselves. They raise margin requirements. The CME did this in late December, raised silver margins by 30%. If you were trading silver futures with a $25,000 margin, you suddenly needed $32,500 overnight. What happens when you do not have that extra cash? Forced liquidation. Your position gets closed automatically. And here is where the cascade starts. When your position gets liquidated, that sell order pushes the price down. That lower price triggers the next trader's margin call. Their forced liquidation pushes price down further. That triggers more margin calls, more forced selling, more liquidations. This is not panic. This is mechanics, pure machinery. Liquidations triggering liquidations, a waterfall of forced selling that has nothing to do with fundamentals and everything to do with leverage getting squeezed out of the system. Now combine that with the Microsoft shock, tech crashing, AI bubble fears spiking, traders reducing risk across the board, and you get what happened on January 29th. Not one factor, multiple forces hitting simultaneously. Microsoft earnings destroying growth narrative. Margin pressure forcing liquidations, profit taking after massive rallies, month-end rebalancing, all converging at once. But wait, let me show you something most people missed entirely, something that reveals what is really happening beneath the surface. While paper silver crashed from 121 to 107 on the COMEX, physical silver in China was trading at $141 per ounce. In Japan, $135. In the Middle East, $128. Read that again. Paper price crashed $14. Physical price barely moved. In some places, it went up. A $34 premium in China while COMEX was bleeding. The paper market and the physical market completely disconnected. That is not normal. That is not how functioning markets work. That tells you something fundamental is breaking. And here's another thing nobody is talking about. For 5 straight years, the world consumed more silver than mines produced. 230 million ounce annual deficit every single year. That is like draining an Olympic swimming pool every week with no way to refill it. Mine depletion accelerating. Industrial demand from solar panels, electric vehicles, semiconductors, all growing. Supply shrinking, demand rising. These fundamentals did not change on January 29th. Not one bit. While you watched red candles, central banks were still buying gold. Russia, China, India still accumulating. The de-dollarization trend still accelerating. Countries still building alternative reserve systems. The supply deficit still real. Nothing fundamental changed. Only sentiment changed. Weak hands got shaken out. Strong hands accumulated. And this is where the pattern becomes critical. December 29th. Silver crashes 16% in one day. Fear everywhere. Social media full of doom. People calling for the end of the bull market. Then January explodes. 65% gains in silver. 30% in gold. Record highs shattered. Everyone who panic sold in December watched the rocket launch without them. Now look at January 29th. 2 days before month end, sharp crash, panic selling, same pattern, same timing, same fear. Will February repeat January's move? The bull case. Everything that drove metals higher in January is still in place. Central bank buying, de-dollarization accelerating, supply deficits deepening, physical paper divergence widening, and crashes in bull markets are historically buying opportunities. They shake out weak hands, reset overbought conditions, create fear, then big players step in and accumulate. The rally resumes stronger. This happened over and over in this bull market. But I could be wrong. The bear case. Tech could crash harder. AI bubble could pop completely. Risk off could spread to all assets. China data could deteriorate further. We could see another leg down, gold testing 4,800, silver testing 90. That scenario is possible, maybe 30% probability. Now here is my specific prediction. Silver will close above $120 by February 15th. Not just touch it, close above it, 17 days from now. And if I am wrong, I will post a public correction right here on this channel. Here is why I believe this. The crash brought silver from 121 to 107, $14 down. Massive in the moment, but nothing compared to the 65% rally we just had. The December pattern says we bounce. The fundamentals say we bounce. The physical paper divergence says we bounce. And February 15th is when the government shutdown drama resolves, when month-end rebalancing completes, when new capital flows begin. $120, February 15th. On the record, hold me to it. But here is what matters more than my prediction: how you respond to this crash. If you are holding physical gold and silver, do nothing. Physical metal is not a trade. It is insurance, long-term wealth preservation. You do not sell insurance because the market had a bad day. You do not have a loss until you sell. Until then, it is just a number on a screen. Your ounces did not disappear. Ignore the noise. Come back in 6 months. Fundamentals have not changed. If you are trading with leverage, today was your wake-up call. Leverage in volatile markets is a death sentence. Here is how leverage kills you. You use 10 times leverage. Price drops 10%. You are at zero, but it gets worse. When you get liquidated, your forced sell order pushes price down further. That triggers the next trader's liquidation, and the next, and the next. This is why crashes happen in minutes, not hours. If you are using leverage on precious metals, reduce it dramatically or eliminate it entirely. If you are waiting with cash, this might be your moment. The best time to buy is when there is blood in the streets, when fear is everywhere. That is when the wealth transfer happens, from the panicked to the patient, from the fearful to the prepared. But only buy what you can hold through more volatility. I cannot promise this is the bottom. Buy in tranches, not all at once. Average into your position. If you bought at the top, watching your portfolio drop double digits hurts. I understand. 2 choices. Panic sell, lock in losses, make them permanent, or hold through volatility. Wait for recovery. Bad timing is not a bad investment. If fundamentals are intact, timing mistakes get corrected over time, but you have to survive the drawdown emotionally. You have to watch red without panicking. Can you do that? Only you know the answer. Now let me show you what I am watching to predict what happens next. 4 things will tell us everything. Number 1, Microsoft and tech earnings. The AI narrative drives risk appetite. If tech stabilizes, metals bounce. If tech crashes harder, everything bleeds. Number 2, CME margin requirements. Watch for any new increases. They trigger mechanical selling regardless of fundamentals. Number 3, physical paper divergence. If Shanghai premiums keep widening, it confirms the paper market is breaking. That is massively bullish long-term. Number 4, Month-end and quarter start flows. New money comes in at the beginning of periods. February 1st through 5th will show us if buyers return. These 4 indicators show you what comes next. Watch them carefully. Here is what you need to understand about crashes like this. Markets are designed to transfer wealth, from the impatient to the patient, from the emotional to the rational, from those who react to those who prepare. Today, trillions of dollars changed hands. Some people lost that money, other people gained it. The question is which side of that transfer you are on. If you panic sold today, you transferred your wealth to someone else, someone who was waiting for this, someone who understood the game. But if you are still holding, you still have a chance. The game is not over. December crashed. January pumped. January crashed. February is coming. The pattern is right there. Will it repeat? We are about to find out. Markets do not care about your feelings. Markets do not care that you are scared. Markets do not care that you bought at the top. Markets only reward those who understand them, those who prepare for moments like this, those who have a plan before the crash happens. If you did not have a plan going into January 29th, now is the time to make one. What will you do if we crash another 10%? What will you do if we rally 20%? What is your strategy? Because there will be another crash, and another rally, and another crash after that. This is how markets work. This is how it has always worked. The question is not whether volatility will happen. The question is whether you will be ready for it. The difference between success and failure is never intelligence. Smart people blow up their accounts all the time. The difference is preparation, emotional control, having a plan, sticking to the plan. Today tested everyone. Today separated the prepared from the unprepared. Today showed you who you really are as an investor. Did you like what you saw? If you found this breakdown helpful, if you now understand what actually happened on January 29th, make sure you subscribe to this channel. I do not do hype. I do not do hopium. I show you what is actually happening so you can make better decisions. And watch the next video here, because what happens in the next 2 weeks will determine whether this crash was the end or just the beginning of something much bigger. Remember this, crashes do not destroy wealth. They transfer it. From those who panic to those who prepare, from those watching the wrong charts to those understanding the machinery beneath. The only question is which side you choose to be on. Trillions changed hands today. Make sure next time you are on the right side of that transfer. Watch another video here to stay ahead of what's coming next.